Inflation was the big buzzword of 2023, but will it continue in the new year? I'm pulling out my crystal ball and talking to the experts to see how the new year could affect your bank account. It's all coming up next. Welcome to Your Money. I'm your host, Gordon Severson. Today I'm talking about inflation. If I had $1 for every time I heard the word inflation last year, I would be a millionaire by now. It's a complicated issue and it affects so much of our everyday lives, from credit cards and bank accounts to buying a new car or setting up a mortgage for a new home. But don't worry, I did some research and I spoke to the experts about how to create your best budget for 2024. I'm talking about inflation because it has been squeezing American families, but economists are optimistic that things are improving. One sign that things are getting better, higher than expected jobs numbers. Across the U.S., more than 200,000 people were hired in December, but that's only one factor that can boost everyone's spending power. This story from Georgia has more details.
The final numbers for 2023 now in, and they show a surge of people going back to work, keeping unemployment below 4% in Georgia and nationwide. Treasury Secretary Janet Yellen.
The labor market continues to fire on all cylinders.
As a result, Nella Richardson of ADP says that means more workers have more money to spend.
Overall, it looks like a very solid picture for the labor market to underlie that continuous consumer spending that drives the U.S. economy.
In Atlanta, economist Ray Hill with Emory's Goizueta Business School points out that gas prices are falling, but there is bad news about prices for just about everything else.
The prices are still higher than they were before we had this burst of inflation, and they're not going back down ever again.
Hill says the good news is that wages continue to rise faster than inflation. 6
months ago, people were talking about a recession coming or the economy falling apart. You know, the Georgia economy is doing fine, and the Atlanta regional economy is also doing fine.
Some employers, including restaurant owners, are not able to fill all the jobs that have remained open since the pandemic.
We are still having a very hard time finding employees.
Restaurant consultant Izzy Karish with Hospitality Works says chefs are still scarce, but servers have started to come back to work as customers return.
Just about all of my clients did better last year than they did in 2019.
Economists seeing many signs that everyone's spending power could start to increase in 2024.
The U.S. Bureau of Labor Statistics reports there are more available jobs in government, healthcare, social assistance, and construction, while transportation and warehousing lost jobs. New year, new car? For some people it is, but payments for Americans are higher than ever. On average, it's $726 a month for a new car and $533 for a used vehicle. Then those payments can stretch for 72 to 84 months. As inflation continues to push prices up, here's a tip from Texas for lowering your costs.
So inflation has hit every part of our lives, and that has definitely crossed over into the vehicles that we drive.
I drive a truck, so you look at, 4 or 5 years ago, the same truck would have been maybe $29,000. Now it's $60,000. The same exact deal.
With much higher car payments, especially with the new interest rates that we have, Rolanda says you might have to take that note out even longer to keep that monthly payment down.
Again, I would look at your budget and say, hey, what do we want to pay? Of course, the longer the note, the longer the time, the smaller the note. But if you can find a way to pay that thing off in 3-4 years, or making some extra payments along the way, by all means, go for it. Because locking in at a high interest rate over that long time frame is going to take a lot of money out of your pocket over that time frame.
Now listen up, because here's a big saver. Say your payment is $500 per month. By paying $250 on the first, you stop and satisfy the interest for the entire second half of the month. And then when you pay $250 on the 15th, it all goes to principal. You could shave as much as 1 year off the loan by doing this.
Oh yeah, splitting the payments, paying twice a month. That was something that I learned 2 years ago now, that I was just like, oh wow, I didn't even know. And so being a financial advisor, that's kind of crazy. I was just like, well, man, I could have paid off a couple of cars a lot sooner.
Keep in mind that the average electric vehicle is $20,000 more than a gas car, but is it worth it?
Well, the thing with the EV, and it's something that's very intriguing to, I know for me, is that, all of the savings that they talk about with gas and this, you make up more than that, just the cost of the car in general.
But will you make all that money up for the cost of the EV? Probably remains to be seen what happens to fuel costs. So I just posed the question to Rojo straight out: used car or new car?
You want to save some money, if you're in the saving money aspect of your life, used car, definitely. A lot of the times, enterprise or rental cars, I've learned this over my time, is those guys don't even let you rent out a car unless it's like new. So what you're getting from an enterprise or a Hertz or something like that, it's a used car, but it's basically the mileage and everything may be high, but it's a brand new car.
So if you're trying to decide between a new or a used vehicle, there's a lot to consider. With a new car, you can customize it, choose your favorite color and features. Plus, you'll have the latest technology, the vehicle will still be under warranty, and you're more likely to get a better interest rate. But with a used vehicle, the purchase price will be less expensive, you'll pay less in insurance and fees, and your new-to-you ride will see a slower depreciation in value. So consider your budget. How many bells and whistles do you need? And think about how maintenance costs can affect your wallet. To offset inflation or just to help manage costs, more Americans have been relying on their credit cards. And now that the gift-giving holidays are over, many folks are facing bigger bills. In fact, U.S. credit card debt has surpassed $1 trillion. If you're struggling to pay off your credit card bill, this story from Sacramento could be for you. Check it out.
Like a splash of ice water on your face, getting your first credit card bill after the holidays can be a shock to the system.
Sometimes where people aren't even able to necessarily, make the minimum payments or get those cards paid down because they have ran up that debt.
One option to help you get your spending back on track this new year is a personal loan.
You then take the money that the company is giving you in this personal loan, apply that money to pay off your higher interest credit card balances.
Instead of juggling multiple credit card payments every month, use your personal loan to pay off all your credit card debt in full, leaving you with one consolidated loan that could also save you money over time.
An interest rate on a high interest credit card might be 16, 18, 20% plus, which I'm not afraid to use the word astronomical. I mean, those are very, very high interest rates.
Compare that to the interest rate on a personal loan, which is typically half that, at around 8 to 10%.
The short answer is yes. I mean, the companies and the financing companies that are actually issuing these personal loans are going to check credit. They're going to check, verify income, similar to what a credit card company will do.
Using a personal loan to pay off your credit card debt is not the same thing as being debt-free.
That should, in theory, free you up to have a little bit more cash flow because you're not paying so much in interest as what you might be with these higher interest credit cards.
Spending within your means still matters.
If you're not willing to examine yourself and some of your financial habits, you very well could come back into the same situation that you got yourself into to begin with.
Like they said in the story, being late on credit card payments is a serious thing and can hurt your credit score. So however you choose to address your debt, make sure it's a plan that's sustainable and not outside your budget. Well, we are officially in a new year, but will the money issues and problems and topics of 2023 follow us into the new year? So I've asked economics professor Tyler Schipper from the University of St. Thomas to come on the show and kind of help us look at the year to come when it comes to some of these topics of inflation and interest rates. I think we should start off kind of at the beginning. If we could talk about the connection between those two topics, inflation and interest rates. Those are some of the big buzzwords that we heard so many times in 2023. What's the connection and what is the Fed kind of trying to do right now?
Right. I think of it as a causal connection. So the way that the Federal Reserve interacts with the economy is to try and increase interest rates up or down to either try and push it along or kind of pull it back. And so as we saw inflation pick up after the pandemic, the interest rates had to rise because that was the Federal Reserve acting to try and tamp down the economy and get inflation back under control. So when inflation goes up, interest rates tend to rise because that's the monetary policy lever. Likewise, when inflation gets too low or if it gets into deflation, we will see the Federal Reserve lower rates to try and help the economy out.
And I know the whole time they've been trying to kind of find that good balance where it's not too much that it, forces us into a recession or affects the economy. Do you think so far they've been kind of able to do that happy medium?
And this is where the analogy about the soft landing comes from, is trying to put just enough pressure on the economy so that we slow down inflation without sending it into a recession. And so far, I mean, I would not have expected it. I think most economists, if you'd gone back to beginning of 2023, would have said we were headed for a recession. And the Federal Reserve's kind of defied odds here, that we do look like we're headed for that mythical soft landing at this point, where inflation is coming down more quickly than people would have expected even, especially in the latter part of 2023. And the economy still looks resilient. We had high growth towards the end of 2023. And the job market has been extremely resilient and kind of exceeded expectations every turn along the way.
Yeah, I think that was one thing that I wouldn't say it's an anomaly, but it was something that was kind of a little different than what people were expecting was the job market was going to do as well, considering these circumstances. I think people expected certain companies or industries to pull back on jobs, but that was a big, a high point, a positive of this whole experience.
Absolutely. And when you compare, for instance, a good economic year, so if people think about 2019 before the pandemic as a good economic year, the economy in 2023 created about 40% more jobs per month than it did in 2019. And that was despite the Federal Reserve trying to slow down the economy with raising interest rates. So it's been a good year. And even some industries like you spoke of, like construction, for instance, tends to be an industry that we think of as being very sensitive to interest rates. But even in the latest jobs report that just came out today, the construction industry still added jobs. And so I think that speaks to the resiliency of the jobs market, even with interest rates going up.
What did we see at the tail end of last year in November and December with the numbers when it came to inflation and prices overall? Were they positive? Was there some positivity heading into the new year?
And I think a lot of this, the answer to this depends on what you think of as positive. So for macroeconomic indicators, inflation was coming down. So it started 2023 and it about halved itself during 2023, and it's only about a third of its peak. So certainly inflation, or how fast prices are changing, was down. That doesn't mean prices were down. People were still feeling a lot of anxiety throughout most of 2023. And because prices were falling, or the rate of price increases was falling, that allowed the Federal Reserve to kind of put the brakes on further interest rate increases. And stock markets kind of interpret that as their go sign, that if rates aren't going to keep increasing, that means that firms might be more profitable, can make growth investments, and they're forward looking. So they're already looking to 2024, and hopefully when rates start to decrease in 2024, they're building that into stock market valuations today.
I remember when that happened, there was a couple of really good days in your retirement account when that happened. It was maybe a good week or so. It's kind of quieted down a little since then. And here, when we're recording this interview, it's kind of the first week or two in January. We're starting to see some negative days in the stock markets. What are we kind of seeing in terms of the thought about the situation in the economy here in the new year?
So there's talk about like a Santa Claus rally, that typically in January stock market returns are higher for a variety of reasons, and we're not seeing that this year around. And part of what's tricky about the stock market is it is forward looking. So what we saw in December was based on what traders thought interest rates might do going into 2024. And any deviation from that can mean that there's a little bit of pessimism now starting in January. So 2 data points already this week that could have led to some of that. One is that the Federal Reserve released its minutes from its last meeting in December. And what wasn't in those minutes is a discussion about when interest rates might come down. So if market traders had believed interest rates were going to start coming down right away in 2024, that was a little bit of a disappointment. The other one that's kind of mixed is a new jobs report came out this morning. It showed we added 216,000 jobs, which was another expectations defying jobs report. And that kind of shows that there isn't necessarily a green light for lowering rates right away. The economy is still really strong, and the Federal Reserve might be concerned about any kind of inflation rearing its ugly head again. And so they're going to be a little bit more hesitant to lower rates until further into 2024.
We should, for people who don't know, we should talk about how with interest rates, a reason why there's a connection with the stock market is because a lot of these companies will borrow money to expand, to buy buildings, to buy equipment, and interest rates, the higher they are, the more they have to spend to make those investments and to expand. And so the thought is that the higher the interest rates, they might be de-incentivized. They might not want to make those investments. And that's kind of why there's that strong connection with the stock market, right?
Absolutely. So, and that's more for a lot of growth stocks, right? Firms that their valuation depends on them continuing to grow. You also have the retail side of this, which is for stocks that people need to buy their goods or buy their items or services, that slowing down the economy with higher interest rates makes those kind of that revenue decision for those firms. It puts a little bit of pressure on it too. So you can get different channels for why it affects stock evaluations, but I think the one that you pointed out is probably the primary one.
And the Fed has already signaled that they're going to be cutting interest rates in the new year. They haven't announced a timeline yet. When are you kind of expecting the first cut to happen this year?
So certainly not at their first couple of meetings would be my expectation. I think the Federal Reserve has done a really good job of signaling when they're going to start cutting rates, or at least how they're going to start cutting rates, which is they do a lot of openness with saying, hey, here are our expectations for 2024. And they've signaled that they're going to cut rates 3 times. But in a lot of their statements, they're also saying, we're going to hold them constant now. We're leaving the door open to even increasing. I think that's unlikely. But this is them trying to signal to markets that it's unlikely they're going to be cutting right away in 2024.
And when they do these cuts, how significant are they going to be? We're not going to be seeing like a percentage point at one.
No.
It's going to be much smaller, right?
Yes. It's not going to be like the way that they increase them very rapidly with these 75 basis points increase or 0.75%. It's very likely going to be 25 basis points or 0.25% at a time. Wait for a meeting or 2 and then do it again until they get down to what's sometimes called a neutral rate, which is an interest rate which doesn't hold back the economy, but it also doesn't push it forward. And so that the Federal Reserve kind of is a neutral force in the economy rather than one trying to constrain economic activity.
And the concern here is that they don't want to cut too fast and go backwards and accidentally bring inflation back, right? That's what they're worried about.
So if they cut too quickly and all of a sudden everybody kind of goes bananas and starts buying things and traveling and those things all sound good, but if we get back to a situation where inflation's too high again, that eats into people's real earnings, that's not good for anybody.
For sure. So one thing with these interest rates going down in 2024, a lot of people who are borrowers are really hoping for some relief. What people who have credit card debt and are looking at those interest rates, what might they see and when might they see a change there?
So some of the short-term interest rates are tied really directly to the Federal Reserve's decisions. So when we talk about the Federal Reserve and interest rates, we're talking about a specific interest rate, which is the federal funds rate, which is the rate at which big banks loan each other money. Nobody gets to borrow at this rate except big banks. You and I don't get to borrow at this interest rate. But other interest rates in the economy are kind of tied in a web to that interest rate. And interest rates like your credit card or auto loans or, God forbid, payday loans that you might have to utilize, those are going to very dramatically and quickly follow whatever the Federal Reserve does. And so a very short timeline there. So as soon as the Federal Reserve starts lowering rates, you should see that in your credit cards very quickly afterwards. Now, 0.25% maybe doesn't seem like a lot, but when you're drowning in credit card debt or struggling to get those payday loans paid off, even small changes in the interest rate can help you make big progress.
And then if they do 3 at a quarter, that'd be 3 quarters. If they do more, there's others who think they might go in the 4, 5, or 6 cuts. We could get into maybe 1.5%, percent, and that would make a big difference for some people.
And you're talking about the difference here between what the Federal Reserve is saying and what market participants or the stock market seems to be pricing in right now. They're much more optimistic about the nature of rate cuts than the Federal Reserve is outwardly saying.
A lot of people are also curious about mortgage rates if they want to buy a new home. What might they see in 2024 in terms of the rates going down with what the Fed is doing?
I think there's a little bit more of an unknown here. And the reason is that we talked about this web of interest rates, and mortgage rates are a little further away on that web because they're a long-term interest rate. They tend to be more connected to the 10-year Treasury yield, which is the rate at which the government borrows money from investors. And as an example, towards the end of 2023, the Fed funds rate, or the rate at which the Fed was setting their target interest rate, was more or less flat. But at the same time, mortgage rates continue to go up because the Treasury, 10-year Treasury was going up. And so they're not always directly tied to each other. And so, you know, we should probably get a little bit of relief as the Federal Reserve starts to lower interest rates, but it's tied to a lot of other factors that I think leave some more unknowns there.
Is one of the other factors also inventory? I know that a lot, that when it comes to housing and building new homes, it's perceived that there's not going to be enough to match the amount of buyers. Mm-hmm. Could that have an effect on the interest rate as well in 2024? So
the interest rate and prices kind of have an interesting interaction here, which is, think about interest rates as being a cost of buying homes. And so when that interest rate on mortgages starts to fall, one of the ways that can also get reflected in the housing market is housing prices kind of increase as more people kind of step off the sidelines. Now, in this case, that demand effect could be partially offset by a supply effect, which is a lot of people have been holding off on selling their homes because of high interest rates. And you have this really interesting dynamic where most of the houses on the housing market typically come from existing home sales, but existing home sales have been very slow. And so it's actually new home sales that aren't the majority yet, but have definitely picked up because there's not as much inventory in the housing market as we typically see.
My last question for you is, summing everything up, looking into 2024, what are some of the big themes that you expect to see? What are some things that people should be keeping an eye on in the new year here?
Yeah, I wish I had a crystal ball. And anything about predictions, I will tell you that very, very smart people at JP Morgan and Goldman Sachs also have wildly different expectations for 2024. And that tells you that even smart people can have very different expectations. I think the themes that we're likely to see is one we've talked about, which is when will the Federal Reserve start to lower interest rates? And whether that is occurring because inflation is under control or whether they're having to do that because of some other perceived weakness in the economy. So that's one theme. The other theme that I've been watching a lot is how do consumers start to respond to this good economic news? At the very tail end of 2023, we saw a couple upticks in consumer sentiment, how consumers feel about the economy, what their expectations are like going forward. And this hadn't been the case, that even with a trickle of good economic news, consumers were generally pessimistic about the economy. They felt a lot of anxiety still, real anxiety that they were saying and reporting in poll after poll after poll. But there seemed to be at least a data point or two that was changing. If that changes going into 2024, I think that could be one of the big stories about consumer sentiment changing about the economy because some of that good economic news is finally starting to trickle into their own personal economies.
That they're starting to feel it.
They're starting to feel it. And that can take a long time with how drastic inflation was, that we had many months of decreasing real earnings. So once you account for inflation, what can you actually buy? But we're now on this path where it's small, but CPI inflation has been less than wage growth has been. And so that's a good metric for people can actually buy a little bit more stuff than they could a year ago. And hopefully that trend continues.
Well, thank you so much for breaking it all down for us, giving us what I think is some good hope for 2024. So thank you so much.
I'm hopeful as well, and thanks for having me.
I bet if I asked you to recite a friend or family's cell phone number off the top of your head, you wouldn't be able to. That's certainly not uncommon these days. But there is one phone number you're probably familiar with. 8675309. You guessed it, it's Jenny's number from that classic song by Tommy Two-Tone. Well, it's also the number for a man in Charlotte, North Carolina. He thought that using his number to cash in on a rewards program at his local grocery store wouldn't be a problem. But this thrifty shopper may want to lose Jenny's number after all. Here's the story.
If I can find out where the Friskies are.
Picking up a few things at his local Food Lion.
This is my buddy girl's favorite right there.
For his cat buddy girl, Chris Ock scans his items at the register. and types in his phone number for rewards, one you might recognize. The Charlotte version with the same last 7 digits as Tommy Two-Tone's 1981 hit 8675309 or Jenny.
So when I got that number, it was probably one of the things on my bucket list, actually.
And every time Ock checks out and enters his number, it shows how much he has saved for the year.
It's $92,965 is what I've saved.
Which means he must have spent millions of dollars at Food Lions across the area.
Within the year, it's just with the year profile.
But how is that possible? For him, it's not. Ock suspects when someone doesn't have an account, they use his phone number so they can save some money. At the bottom of the rewards app, you have a choice to donate your savings to a good cause, and that's what Ock was looking to do. But out of the blue,
they called me up and they said, by the way, your phone number cannot be used anymore.
Food Lion disconnecting Ock's version of Jenny's number. When his number was turned off, his savings dropped to zero.
I want to make sure that they use what's going in there.
We reached out to Food Lion about the phone number. The company says due to high volume of activity associated with the number, their system alerted a potential misuse. And as for the charitable donations, Food Lion says, quote, the customer has the ability to donate an average of $20 a month from the savings. Not the full $92,000, but about $240 for the year.
But I guess it caused such a panic that they had to turn it back on. Now I've saved $7,000 in 2 weeks.
Food Lion says one family or household should only use that phone number, so the store plans to deactivate the number again.
I got a call to say that they're shutting me down. And they said, well, we can do whatever we want here at Food Lion. You can't use your phone number anymore. Pick an alternate number.
A classic song causing quite a stir. While Two-Tone pleading with Jenny to not change, Food Lion doing the opposite.
No word on if that situation has been resolved, but it's a good reminder to pay attention when you sign up for any rewards program. You know, inflation is a complicated issue with a lot of moving parts. But if you stay focused on your plan, your budget will weather these difficult times. Well, that's all for today's show. I'm Gordon Severson, helping you save, spend, and invest your money wisely. We'll see you next time.